Veridelisi speaks now. Listen to me. Corridor versus floor systems. A complete guide for central bankers. Fed, before 2008. The Federal Reserve influenced the federal funds rate through open market operations, OMO. These operations, involving the buying and selling of securities in the open market by a central bank, are a crucial tool employed by the Federal Reserve in monetary policy. It used OMOs to adjust the supply of reserve balances so as to keep the federal funds rate around the target established by the FOMC. The corridor system in monetary policy refers to a framework established by two key interest rates, the discount rate and the interest on reserves rate. The discount rate, primary credit rate, is the interest rate at which the Federal Reserve is willing to lend funds against collateral to banks in good standing. This rate tends to create an upper bound, or ceiling. The interest on reserves rate represents what banks earn on the funds deposited in their accounts at the Federal Reserve. This rate tends to create a lower bound, or floor. The Federal Reserve's monetary policy framework did not have a formal lower bound until 2008, leading some authors to describe it as an asymmetric corridor. To highlight how reserve supply influences money market rates, figure shows a stylized depiction of the relationship between the overnight interest rate and banks' demand for reserves. Prior to the global financial crisis, GFC, the Federal Reserve operated a regime in which just enough reserves were supplied, the green vertical line in the graph, to meet banks' reserve requirements and payment needs. The floor system. The new monetary policy conducted by the Fed after the crisis is based on the floor system. To understand the floor system, we have to go back to the days of the crisis. In the early days of the crisis, the large amount of liquidity injected into the market by the Fed caused the federal funds rate to fall rapidly. This significant deviation showed that, in the absence of a floor rate, the federal funds rate could move towards zero. In response to the current situation, the Fed decided to pay interest on required and excess reserves in October 2008. In this way, a transition to the floor system was achieved. In the floor system, the target interest rate is directly equal to the base rate, the central bank borrowing rate. Then the Fed could provide so much liquidity to the financial system. Fed no longer relies on OMOs as the principal policy tool to target the policy rate in its day-to-day normal operations, because small shifts in the supply of reserves have no impact on the FFR by design. Instead, the Fed would lower its IOER rate and RRP rate, shifting the bottom of the demand curve down, which induces market rates, including the FFR, to move in the same direction and by a similar amount. To be clear, the lowering of the IOER rate and RRP rate puts downward pressure on the federal funds rate and other market rates by lowering the incentive to hold reserves at the Fed. This system is called the abundant reserve regime because the Fed has created significantly more reserves. You can see from the following graph how the reserves are growing in this period. Monetary Policy Benchmarks 2023 shows 43.8% of central banks operate with a corridor system and 21.9% use a floor system. Thank you for listening to me. Veridelisi loves you. Follow please https://veridelisi.substack.com.